two parts of a balance sheet that see the most daily action are current assets and current liabilities. This is where the operating activities of business are conducted. The daily business cycle of buying inventory, selling inventory, receiving cash, paying for expenses and paying creditors represents by far the most change necessary in the ledgers of a typical business. If you think about it, buying non-current assets and applying for long-term loans do not happen every day. The topic this week is focusing on the receivables section in the current assets part of the balance sheet. There are different types of receivables, but for most small to medium-sized businesses, accounts receivable is by far the main one. Other types of receivables are bills receivable, where more formal arrangements are made for financing purposes, and loans to various members of the business organisation. These are rare and not accessible in this unit. But before we discuss accounts receivable, let me say that many successful small businesses are completely avoiding having accounts receivable due to the use of credit cards, EFTPOS sales on debit card and debt factoring. These alternatives to having formal accounts receivable will be discussed in this unit, but the principal focus here will be on the management of accounts receivable. The whole idea of having accounts receivable, also known as debtors, is to increase sales and therefore income, but having accounts receivable comes at a potential risk, as not all debts will be collected. Also, to promote credit sales to these customers, businesses will most likely need to offer incentives, such as discounts for early payment and allowances, such as sales return possibilities. To minimise any potential risks, credit checks can be performed on new customers, but normal businesses are not in a position to do this, as they lack the time and expertise to do so. When debts do turn sour, there are two ways to write off the unpaid amounts: the allowance method and the direct write-off method. Both these methods will be discussed in this unit. The direct write-off method is used for businesses that experience few bad debts, and the allowance method is for businesses for which bad debts are far too common. For these businesses, they will need to estimate their bad debts at the end of an accounting period in line with accounting standards. Even though the bad debts will not be known exactly, businesses are able to legitimately estimate the period's bad debts and write off the expense. This will have the effect of creating an allowance for doubtful debts in the balance sheet, which will be deducted from the asset account of accounts receivable. In simple language, businesses are allowed to estimate their bad debts before they actually become bad, due to past experience and a fair degree of educated guesswork. This estimate is called doubtful debts and is an expense. Doubtful debts are kept out of the accounts receivable account because a business does not know which debts will become bad, just that there is a good chance that some debts will become bad. The doubtful debts then enter the income statement as an expense in advance of an actual bad debt taking place, where the bad debt can be identified. To avoid having bad debts, one method of doing so is to perform credit checks. However, credit policies need to be monitored and, if necessary, changed from time to time. These policies can be such things as who should be allowed credit, who is authorised to determine the limits of that credit, and what terms to offer. Another common problem is not monitoring ratios such as accounts receivable turnover, which shows the average time taken in days for an account receivable to pay up. Letting this get too long would have a serious effect on cash flow and should be monitored regularly. Another way to eliminate bad debts is to sell your debtors immediately the sale is made. This is known as debt factoring and is common in businesses where they may not have the expertise to deal with credit control. For example, furniture, white goods and carpet selling businesses, debt factoring to a third-party finance company is very common. By far the simplest method to avoid bad debts is to allow sales with the use of credit cards by customers. Although this will represent an expense to the business, the increase in turnover and sales revenue should overcome any additional costs. Also, the use of debit cards eliminates bad debts as this is effectively a cash sale. Finally, in this topic we will discuss the use of bills receivable, or as they are commonly called, bills of exchange. These are uncommon in most small businesses today, but do form a considerable part of medium to large businesses' credit offerings. Bills of exchange are one of the oldest forms of credit known to businesses and are very common in international trade.